Hello all! Today, we are very pleased to have Thomas Drissner, Portfolio Manager of abrdn's Short-Dated Enhanced Income Fund, or SDEI. He has very gladly offered to share his thoughts on the fixed income segment and to highlight the many opportunities within the shorter duration bond space. Let's start off with the first question. Could you tell us more about your fund management team as well as the broader fixed income team that supports the fund?
There are two fund managers, 𝗪𝘆𝘆, who's based in Edinburgh, and myself, Thomas Drissner, I'm based in Singapore. Both of us have experience in managing income funds, and we wanted two portfolio managers in different locations because SDI really invests in the global fixed income universe. So I myself cover the Asia-Pacific region, and my colleague keeps an eye on European credit markets and the US market. Of course, in a typical abrdn fashion, it's not only the two of us managing the fund. We have a very large team, 140 investment professionals in different locations who constantly produce ideas, and our job is to introduce these best ideas on the short end of the credit curve into the fund in order to ensure that the fund delivers what it's supposed to.
Thank you. So truly a global fund indeed. Could you tell me what are the key features and investment merits of your SDEI fund?
So the key feature I want to mention is stability. We wanted to construct a portfolio that's stable and of high quality, that doesn't rely on a lot of interest rate risk and doesn't purely rely on going down the credit curve, i.e. introducing a lot of high yield into the fund. And that's a result of 2022, which was a very difficult year for global fixed income markets, as you know, and we saw the need for a safer, more stable proposition. Saying that, however, we also know that especially the Asian investment community is looking for yield. So we are really trying to find a good balance between stability and a high level of income, and I think we have found it.
Thank you, that's great to hear. So in your opinion, how is SDEI different from, and how does SDEI stand out from other bond funds out there?
So one feature I mentioned, it is a fund that doesn't want to be the highest yielding fund out there. The average credit quality of the fund is A-, which is fairly high. But also we put a lot of thought into the fund guidelines. We designed them such that we have the ability to be sufficiently flexible in order to enhance the yield, hence the name of the fund, but also not having to rely too much on credit risk or interest rate risk in the fund in order to deliver a high level of income. I can give you a couple of examples.
Sure.
So typical yield enhancers would be emerging market debt, for example. Also the subordinated corporate bond market is always a favored way to enhance the yield of the fund, and high yield markets, of course. But all these yield enhancers are limited. So even though it's a constrained investment universe, we have very strict guidelines in order to make sure that the fund is not overly volatile and to manage a max drawdown. So to share examples, we think we can manage the fund at a volatility of max 2% and a max drawdown of -3%, which is fairly good.
Yeah, I think it's very clear that you put a lot of thoughts into managing your drawdown and volatility. So could you please comment on the performance of your fund relative to some other bond indices out there?
Yes, so fortunately the performance has been fairly good, I would say. We've launched the fund in summer last year. Let me maybe give you an example. What we hear a lot from clients is, so if cash rates are so high, if I can earn 5% on the risk-free rate, why should I go into corporate credit? So we've looked into this a little bit and compared short-dated treasury bills with the performance of SDI. And the outperformance of the fund is quite significant. Another comparison would be comparing the fund to a global AG benchmark, which includes global government bonds and corporate credit. Again, there's an index for the 1 to 3 year space, and we've also outperformed this particular index.
Looking ahead, with the possibility of cash rates coming down in the near future, do you think your SDEI fund will continue being an attractive investment proposition?
Yes, I think so. So if you look at the global yield curve, it's quite an exceptional time because yield curves are so inverted, which means that the very short end is yielding in US dollar terms, yielding 5% plus, and then it drops quite significantly if you go to the 2, 3, 4 year point, down to 4%, 4.2%. So it's highly inverted. This environment is likely going to change, as you say, because central bankers become more comfortable with the inflationary environment and thereby feel sufficiently confident to lower rates. However, on a real-term basis, i.e. net of inflation, bonds will very likely to continue to be an attractive proposition. That's one point. The other one is that the fund is sufficiently flexible to react to a change in the environment. So at this point of time, because that very short end part of the curve is so attractive, that's exactly where we are positioned in the fund. But it doesn't mean that we can term out our holdings a little bit, and that's exactly what we will do in order to keep the yield stable and attractive.
Thank you. Before we conclude today's episode, do you have any final thoughts for our viewers?
SDI is a very attractive composition. It's a stable fund. It delivers high income. It delivers an income level that's higher than just holding cash or holding government securities. So there's really no reason for investors not to step out of cash and make use of that composition.
Thank you very much. And with that, we have come to the end of today's feature episode with Thomas Drissner from abrdn Asset Management. We are really thankful for all your insights on short-dated bonds and the abrdn Short-Dated Enhanced Income Fund. And we hope to have you back soon.
Thanks very much.
Thank you.